Why the oil price is important. Whether you like it or not, oil is still an essential commodity in the world. Oil still plays a vital role in the global economy despite the continued efforts to reduce its use and find alternative green energy sources. In the early days, finding oil during a drill was considered somewhat of a nuisance, as the intended treasures were usually water or salt. Its price can tell us what's going on in the world economy right now, but it significantly influences what could happen in the future. It is telling us that the world economy is in big trouble, a crisis not yet revealed in backward-looking economic growth figures. Oil is traded in contracts that expire on a given day of the month. Whoever is left holding the contract when the contract expires has to take delivery of the actual physical oil. Most people who trade oil have never and will never see a barrel of oil, let alone take delivery of one. Oil contracts are used by airlines and industrial companies to manage or insure themselves against big swings in their fixed costs. Welcome back, guys, to another exciting video of Framework Finance, where in this video we will talk about the importance of oil prices. Number 1. Booming economic growth driving demand for oil. When COVID-19 started, there was a plunge in economic activity and oil demand 2 years ago. Producers were adjusting production levels, but there is only so much one can do without destroying reservoirs of capital. Storage capacity is also limited. Moreover, there was uncertainty about how severe the economic crisis would be and how long it would last. These compounded factors pushed oil prices to deficient levels not seen in decades. There was even a short period of time when oil prices went down to minus $40. This difficult period lasted several months. It was followed by a surprising economic rebound, driving demand for oil and oil products. It's estimated that oil demand at this point is back, or has already surpassed pre-pandemic levels. In other words, it has never been higher, nota bene, similarly CO2 emissions. When the pandemic started, there were high expectations for CO2 emissions reductions. Indeed, it materialized and emissions dropped several percent in 2020. But these gains were short-lived, and today it is estimated that emissions are also above that of pre-pandemic levels. Number 2. Limited oil supply due to long investment cycles and cautious capital allocations. Supply has not been able to respond to increased demand fully. OPEC has been scaling up oil production slowly, but it also has limited spare capacity and is probably cautious not to oversupply the market again. Beyond excess capacity, oil production has very long investment cycles. It can take up to a decade to reach the first production when the resources are confirmed. Some unconventional sources can deliver output much faster, but these are limited in scale. Moreover, all producers are cautious in allocating capital. First, they learned their lesson from an oversupplied market when oil prices dropped to minus $40. Second, perhaps more importantly, there is intense pressure on the industry not to develop new fields, hold or decrease investment in maintaining and growing production, and divert the capital to green investments. Number 3. Geopolitical tensions. Geopolitical tensions between Russia and Ukraine and increased instability in the Middle East add to oil market nervousness. Oil is 3% of global GDP, so if 3% of global GDP is twice as expensive tomorrow, clearly this will have some impact on inflation. But I don't think it's a significant driver when it comes to inflation. I believe that loose monetary policies drive inflation. In that context, oil prices will not be the most crucial factor when it comes to inflation, but it is still essential. Why? Because oil is basically in everything. So it's not a volumetric impact, but it impacts the price of almost everything. An increase in oil price will only be seen at the gas station, but it will be felt in virtually all the goods and services we use, because oil is a feedstock, a source of energy, and is used to transport many things. When it comes to oil as a source of energy, depending on where you are, 50 to 60% of what consumers pay at the pump is tax. We tend to focus on the fluctuation in the crude oil price, which is essential, but the big thing that people don't know is that for every €1.50 spent on a litre of gasoline, they pay 70 to 80 cents to the government. Importing countries like the EU make more money from taxing oil than producing countries from exporting it. However, the fundamental issues behind the technical, weird and historic price anomaly are real. Like any commodity, price is driven by supply and demand. Oil demand is a perfect proxy for global economic activity, and right now all the talk is of demand destruction. Planes grounded, cities emptied of cars and factories mothballed. Number 4. The demand component of higher oil prices. When the COVID recession hit the US nearly 2 years ago, oil prices tanked along with the stock market. As the novel coronavirus spread around the globe, governments rapidly imposed lockdowns in an attempt to protect their citizens. Lockdowns drove unprecedented economic disruptions, resulting in less energy demand and falling oil prices. Oil demand returned strong later in 2020 as national governments and central banks pumped trillions of dollars into the global economy to support workers and the unemployed. By early 2021, oil had climbed back to pre-pandemic price levels. Oil demand has recovered swiftly over the past year, even with several COVID waves making their way worldwide, reads a Bank of America research note. Demand in the last 3 months of 2021 was likely within 1 million barrels per day of pre-pandemic levels. OPEC production cuts mean higher oil prices. In April 2020, a spat between Russia and Saudi Arabia over proposed output cuts in response to the new COVID-19 pandemic spooked investors, causing the price of oil to fall to historic lows in April 2020. But that was then. The problem now is that the oil supply hasn't kept up with the recovering demand. The quick rebound in consumption caused crude oil and refined product inventories to fall swiftly from record high levels in mid-2020 to multi-year lows in late 2021, according to the Bank of America's note. That's why the Biden administration, despite arguing for less fossil fuel consumption overall, has called on the Organization of Petroleum Exporting Countries, or OPEC, and its allies to increase oil production. The idea that Russia and Saudi Arabia and other major producers are not going to pump more oil so people can have gasoline to get to and from work, for example, is not right, Biden said at the most recent G20 meeting. According to the US Energy Information Administration, Saudi Arabia, OPEC's most crucial member nation, will produce 10.8 million barrels of oil per day in 2020. That's down from 12.1 million 2 years earlier. OPEC's plan to throttle back its oil wells and the commitment to that plan will likely maintain upward pressure on prices, said CFRA Chief Investment Strategist Sam Stovall. The average price of a gallon of gasoline recently hit an all-time high of $4.17, compared to $2.77 1 year ago. Drivers in California need to fork over an average price of $5.44 a gallon. Ballooning prices are Americans' top concern for 2020, more worrying than their ability to pay bills or broader inflation, according to a recent e-money advisor survey. Record gasoline prices are a direct result of climbing oil prices. The oil price bottomed out in the spring of 2020 during the COVID-19 crash. Still, today a barrel of oil fetches almost $130 in the US. With higher prices a direct result of Russia's invasion of Ukraine, aided by strong consumer demand as the world moves on from COVID-19 and inadequate supply as the leading oil-producing nations throttle output. That's all for today. Make sure to hit the like button and subscribe to the channel to get more amazing videos like this one.